Good morning, ladies and gentlemen. Welcome to our top show, Market Masters, where we get you to meet the finest brains on Dalal Street, people and professionals who've made tons and tons of money for their mutual fund holders, for their shareholders, and have proven over time their ability to tide over bull and bear markets. Today, we are indeed fortunate to host Mr. Rajeev Thakkar, the CIO and Director at Parag Parikh Financial Advisory Services, AMC. Mr. Thakkar is a gold standard of value investing and at the helm of India's most popular equity scheme, Parag Parikh FlexiCap Fund, which in the last 11 years, ladies and gentlemen, has compounded at 19% each year. Very simply, your 10,000 rupee SIP over the last 11 years would have turned into 39.23 lakh rupees. So 13 lakhs is turned into 39 lakh rupees, and the person responsible for that is right in front of us. Rajeev ji, it's a pleasure to host you. A very warm welcome on Business Today Television.
Pleasure being.
Right. We'll start with the very basics, Rajeev ji. This is an opportunity to set the tone, the tenor, and perhaps what is likely to come over the next 3-4 years in Indian equity markets. For the moment, we are undergoing a fairly steep and drastic correction in valuations. How do you see sentiment on Dalal Street? Have we seen the worst behind us?
So that's the question, isn't it? Have we seen the worst behind us? The unfortunate part is there's never a clear answer for the future. Things are very, very obvious when we look back. So hindsight is perfect. Equity as an asset class is something that should be owned only for the long-term wealth creation. So for goals like future education of a newborn or for retirement needs and things like that. It's an asset class that is not amenable for very, very short to medium term needs. Let's say 2 years, 3 years goals are best avoided by being in fixed income or are best served by being in fixed income securities rather than in equities. Where do I see ourselves today? So these kind of corrections are very, very regular, very, very normal in equity markets. A lot of investors have come to the markets post-COVID, both in terms of the demat accounts owned and in terms of the folios created with mutual funds, who would not have seen such a drop earlier. But let me communicate to them very clearly that this is part and parcel of the journey, and only come here if your goals are very, very long term in nature. Is the worst behind us? Unfortunately, I don't have an answer to that.
Okay. Is the worst part of the worst behind us?
So let me put it like this. If we were having this conversation, let's say in February of 2020 or January of 2020 to be safe, would we know that in 2-3 months time all of us would be locked down in our homes and there would be this extent damage of the pandemic? The answer is no. That was unpredictable. So just like life is unpredictable, markets are unpredictable because they mimic the lives and the business environment. What we do know is that 5 years from now, 10 years from now, it is very likely that the well-run companies will be earning a much higher profit as compared to what they are earning today. And again, you are not going to buy a single company. Typically, people construct a portfolio of securities either directly or through mutual funds. So on an average, those companies will do well. And if purchase is at a reasonable valuation, the outcome will be good. So to answer the question that you posed, is the worst of worst behind us? In a lot of companies, yes. In a lot of companies, the answer is no, still. So if the business is not very strong, if the earnings multiple were, let's say, 100 times before this fall started, and the stock has fallen 20%, then 100 PE stock has become 80 PE. Does that make it cheap? Answer is no. Can it fall further? Answer is yes. Just in the past few days, we have come across a company which was quite popular on social media and which has been downgraded to default status by the rating agencies. Now, typically in the bear market, all the problems come to fore. Things which can get pushed out in a rising market. A lot of these kind of problems start coming out in a down market. So, in a segment of the market, there could still be pain left. In a segment of the market, there are interesting buying opportunities emerging. So, answer is again somewhat mixed.
Okay. Thakkar Sahab, I had this idea about you being a very good stock picker and of course a master at valuations, which you indeed are, but I did not know that you could answer questions with such an ease that a politician would also envy. With that background in mind, let us proceed forward. Now, we've seen a sharp correction in valuations, as you very rightly say. Some stocks have corrected 50%, some anywhere between 20-25%, if not less. Now, given the calmness that we see on Dalal Street in terms of momentum and in terms of less noise, how do you see your job at the moment in terms of allocating fresh funds? Have the valuations reached your parameters, or are you still edgy? Do you sleep well?
So, I sleep well all the time, whether valuations are high or low. So, unless one is able to switch off from the markets after we go home, the job becomes very, very stressful and very, very difficult. But in terms of opportunities, it is far more exciting these days to come to work than it was, let's say, 6 months back, where uh, the it was very, very difficult to find anything at all. After the fall, there are segments which are uh, looking interesting and which we are deeply researching and where we hope to find some opportunities. But this thing that, okay, markets have fallen now, let's rush in to buy something, anything. I don't think we are in that kind of a situation. It is surely not a September 2008 or a October 2008 kind of situation or a March 2020 kind of situation that you should simply drain your bank accounts and fill your demat account. It's still not that kind of an environment. And I don't see a, again, someone was asking me, do you see a V-shaped recovery? So
Yes.
stocks have fallen and they should rise back equally quickly. My answer is no. Take your time, build conviction. Everything has to be tick marked. The promoter management quality, the business quality, the balance sheet strength, and finally the valuation. If all four are in alignment, only then one should go and purchase something.
Fair point. I'll request the PCI to please put Mr. Thakkar on full frame, and people will realize that the logo of Parag Parikh Financial Advisory Services AMC is actually a tortoise. And it essentially means that it's slow and steady. It believes in winning the long term race in creating wealth, and that's how it is. Mr. Thakkar, I have been analyzing your portfolio of the AMC, and I see a lot of money going into financial services, a bit into the NBFC space as well. When you are allocating fresh capital, sir, what are the 2 or 3 things that you are keeping in mind, and where is that money going?
Sure. So you have rightly said we own quite a few private sector banks. We own, you referred to NBFC, although it's a conglomerate, it's a mixture of life insurance, general insurance, and other financial services. So this is the broad spectrum where we have invested in. If you look at the Indian markets, the Nifty weightages or the profit pool of the larger companies, a lot of it comes from the banks and financial services companies. So in the Indian market itself, it's a reasonably big segment, and this space has not done too well in terms of the stock price returns that people have got. So in terms of valuations, ironically, these names, the private sector banks that we own, these were attractive even before the fall, and after the fall, they look reasonably attractive. However, we don't run a banking and financial services fund. We run a diversified equity fund. So there are obviously sector limitations and per stock limits that we strictly adhere to. We can't go overboard in any one company or in any one sector. So fresh money that comes in gets allocated to some of these stocks that we already own and that we have liked over a period of time. And as I mentioned, the with the 15-20% fall at the index level and some of the individual names falling even more, there are segments which are looking attractive where we are doing detailed work, and as and when we find opportunities, we will be investing in newer names as well. So broadly, that is the strategy that we are following.
Okay. Mr. Thakkar, in the valuation exercise that you do, and specifically for calendar 2025 and maybe the next 1 year or so, what according to you are spaces where valuations are within the parameters that PPFAS is very comfortable with? Are they large caps? Are they mid caps? Are they small caps?
Uh, so I'll give you a general answer, and I'll also mention that there are a lot of exceptions to these general answers. I'll highlight the exceptions as well.
Okay.
Overall, large caps have been cheaper before the fall. The fall has been steeper in the small and mid cap space. However, even after the fall, the large caps continue to remain cheaper, more attractive as compared to the uh, small and mid cap space. So the in general, the smaller the company, the chances are that the valuation could be higher. There are important exceptions to this. So the exceptions are, for example, even in the large cap space, anything to do with Indian consumption has been very, very expensive, and even after the fall, it remains expensive. So, for example, retailing names across the board, in general, one would find them quite expensive. So, these stocks may have fallen from the peak, but even today, if you compare them to the earnings that they are generating, that would not be such a great thing. Again, some of the startup kind of names where the entire business valuation case is about future market share, future earning, whereas today some of them may be in a cash burn stage. They would be uh, reporting cash losses and P&L losses. Even over there, things are not looking exactly cheap. So there are important exceptions to this. Even in small and mid cap space, there are individual companies which are starting to look quite attractive. So if one is going to invest money in a uh, market market cap based fund, then large cap funds I would recommend. But if one is doing individual stock picking, then one should look across the board because opportunities will be there in various segments.
Okay, ladies and gentlemen, I'd just like to give you a background. PPFAS AMC manages about 1 lakh crore rupees of investor money. Of that, roughly 89,000 crore rupees is in Parag Parikh Flexi Cap Fund. So, by all measures, we can just imagine that about 90% is in a single fund, and that's how the structure is at the moment. Mr. Thakkar, I have noticed in your fund, you have booked very heavy profit and exited many PSUs. Because you have exited, and this is publicly available data, I will just name them: NTPC, ONGC, SAIL, NALCO, BPCL and Union Bank.
So,
I just want to understand.
sir, if I can just interrupt a
Yes, sir,
bit,
please. Yes.
the names that you mentioned, most of them are arbitrage positions. So
Okay.
those never were part of our portfolio.
Okay, fair point. Okay. Let's just ask a generic thought on this momentum space which was dominated by PSUs of all kinds. How do you see the PSU universe There are some PSUs which I will not name where you have increased stake also. They are amongst the top 10 holdings of the flexi cap scheme. So, when you look at the valuation within the PSU segment, what do you like and what are you staying away from?
Sure. So that's a very astute observation. In the upward momentum, a lot of the PSU names went up very, very significantly, and a lot of them have corrected significantly in the current market fall. So one of the interesting points while the stocks were rising was that either they were just going up based on narrative or based on stories that were going around, or in some cases on the basis of very less floating stock. Uh, so let's take the PSU banking space for example. Now the market leader has a nationwide branch network and arguably is attractively valued, whereas some of the very, very tiny PSU bank names where the floating stock would be in single digits as compared to their overall shareholding pattern, those were quoting at uh, valuation levels which were even crossing the best of the private sector bank names. So they were quoting at price to book of 5 and 6 and those kind of names, and whereas the asset quality, balance sheet quality was not there. In fact, the government of India has announced capital raising in some of them. So a lot of the rise was just based on narratives, which has been correcting. Whereas the other companies in the PSU space, things which are backed by robust earnings, low multiples, high dividend yields, and where there are reasonably attractive growth opportunities, those are continuing to do well. So we are adding to our positions in some of these PSU names, whereas some other companies where we find prospects not that good, we have exited.
Fair point. Because this data is public and is available easily on many platforms, over the last 2 months or so, the AMC has raised its stake in Coal India and Power Grid. This is for data to be seen and understood separately. Uh, Another background note on Parag Parikh FlexiCap fund is that it was one of the earliest funds to get into overseas stocks, and that sets the tone. I still remember a time when I think the top 5 stocks had overseas names such as Meta, Amazon, Google, and that rally has been very, very well captured by this 18% CAGR that Mr. Thakkar has given. Rajeev ji, I still find amongst the top 15 Microsoft, Amazon, Google and Meta.
Yes.
Could you just explain the rationale? We are getting feelers from the overseas markets that these top 7 are primarily responsible for this, relative overvaluation that Nasdaq has over many other indices. But because you are a value investor, you continue to hold, and in the case of Google and Amazon, you've added to your positions. Would you explain your overseas strategy?
Sure. So when people talk about overvaluation, again, let me turn the table. You have been asking me a question. Let me ask you a question. What are the earnings multiples of the 4 companies that you have mentioned? Any broad guess, any range?
Sir, they would be sub 10.
Not sub 10, but they would be in their 20s or
Yeah,
thereabouts.
fair point. Yeah.
20s, 30s kind of thing. So, which are not too different from the IT services names that we buy
Yeah.
in India, for example.
Yes.
And whereas these companies are growing faster as compared to Indian companies when you do like for like comparisons in terms of dollar growth rates. That you see. So, of course, arguably, at some point in time, the Nvidia's valuation, some would have concern, or some would have concern over Tesla's valuation some time back, uh, or individual names you could argue, but broadly saying that entire Nasdaq is overvalued is a simplistic conclusion that a lot of people draw. Uh, if we look at let me leave aside the question of valuations for a minute. If we just look at our own lives, any person buying a phone today would typically be buying either an Android phone or a iOS phone, Apple phone. So again, these companies are very, very dominating. Anyone buying a laptop today would most likely being buying a Windows operating system laptop. Again, dominance. People advertising in the digital space would typically be advertising either on Google or on meta platforms like Instagram, Facebook, or using things like WhatsApp and their other services. Anyone using cloud services at the corporate level would either be using Amazon's cloud services or Microsoft's cloud services or Google's cloud services. Uh, E-commerce, again, there are very few dominant players the world over and in India as well. Uh, so whichever trend you look at, whether cloud computing over on-premise, whether digital advertising over linear, generative AI, which is a big thing. Again, these are the companies which have the Gen AI model. So they are on the right side of the trends that we are seeing, and valuations are reasonable. They are not very, very cheap. They are not throwaway valuations, but at the same time, they are not bubble kind of valuations or very expensive valuations.
That's a very good defense of the positions that you've taken. Mr. Thakkar, a view on the broader earnings growth that we are likely to see in 2025 as far as Nifty is concerned. There was a view that earnings growth had slipped to about 5, 6, 7 percentage points, and that's the reason why this sell-off was there. In particular, as far as the Nifty is concerned, do you think this is a comfortable zone to be in, or would it be better off at 19,000 or 20,000?
So, Mr. Bhatnagar, the limitation that I have is that we do not cover all the Nifty companies or all the, so we don't have earnings estimates for each and every of the 50 Nifty components or a broader universe. Uh, I'll generally comment on the earnings growth and how do we see it, but I may not have a answer at the Nifty EPS estimates or things like that. Generally what we have seen is that the earnings growth are better when competitive intensity is less. So, for example, in the telecom space, when we saw too many entrants entering the market, we saw the pricing pressures being there, and later on, when there was a big consolidation where a lot of people exited the space, the pricing power came back, and we are seeing earnings growth coming back. So broadly, recently in a lot of spaces, we are seeing heightened competitive intensity. Sometimes it's because of newer players entering the market, or sometimes because of the technological shifts that are happening or the business model disruptions that we are seeing. So let me give you some examples. So, for example, in the paint sector, the competitive intensity increased because of a new player entering the market. Similarly, in cables and wires, we are seeing announcement of again a entry by a bigger player. We are seeing competitive intensity in the consumption space, where the established FMCG players are battling the newer D2C players, direct to consumer players. We are seeing these battles across segments. So, of course, the quick commerce players are competing among themselves, but there is a competition between uh, the large big box retailers versus the quick commerce players as well. So, one, uh, sales are difficult to grow when too many people are entering the space and trying to compete. That is one aspect. And second is the margins take a beating when too many people compete. Again, we spoke about the business model disruptions. Now, earlier one would think that the two-wheeler space would be limited to 3 or 4 players. Now, when electric two-wheelers come in. So you see more players entering the space rather than just the incumbent. And same thing we are seeing in automobiles, for example, where earlier petrol diesel market was in a somewhat of a equilibrium. Now that shift is happening to EVs, those people also become competitors. So broadly, with all this competition, I think it's a tough environment to grow sales and especially profits.
Fair point, and it will be impolite for me to take names, but from the portfolio that's been analyzed for PPFAS AMC, many of such threads that Mr. Thakkar has just referred to, the fund has very quietly exited those positions. Now let us construct a portfolio, Rajeev ji, of people who are just entering the markets. We are very fortunate as a country that lakhs and lakhs of people have now faith in what the founder of PPFAS started about 3 decades ago, which is equity investing and investing in SIP format. That was Mr. Parag Parikh. Unfortunately, he is no longer with us to see the success that his baby has shown, be that as it may. Fresh allocations, Mr. Thakkar, for those people who are coming into the market now, how would you allocate 10 lakh rupees for a gentleman who's 25 years old, a lady who's 25 years old and has entered the markets via the mutual fund route?
For a person 25-year-old and who has a stable income and who has other needs taken care of, like life insurance and general insurance, life insurance if they have dependents, out of 10 lakh, maybe 9 lakh could go to equities for the longer term. The only thing is that don't stop the journey midway. Don't fixate too much on the upward and downward movements of the market. So for this 25-year-old, let me highlight a few things. If this person is in formal sector employment, has a corporate job or has a job with a big employer, this person most likely will be part of the employees provident fund system, and this person will pay money into EPFO for 35 years till retirement. If this person buys gold, most likely that gold will go down 2, 3, 4, 5 generations. That will never be sold. The house that this person will buy, they will live in it for decades. It's just that when it comes to equity investing, the AMFI data and other data shows that people stick around for maybe 2 years, 3 years, and then get jittery. Keep switching all the time. So allocation is easy. Answer to allocation is easy. Put maybe 90% of the money in equities, but stay the course for 10, 15, 20 years. Don't try to get a quick buck and try to shuffle between different securities, different mutual fund schemes and all of that. It's meant for long-term wealth creation.
Fine. Mr. Thakkar, unfortunately, time draws to a close. It's the only communist that we've left in this world. It's equal for me, equal for you. You have another meeting to attend. And thank you so much for your time. What a pleasure listening to you. My final question to you is, sir, when you look at an investment thesis on your table today, forget management quality, forget earnings growth and so on and so forth. What are the 3 basic things that you are looking now in this kind of a market?
So I don't ignore management quality. So management quality comes.
That was a given.
Is part of the equation. The business quality is part of the equation. But largely, one doesn't want to overpay. That is one basic requirement. And one wants the company to survive. One should not get into companies with very, very weak balance sheets or some of the warning signals, like if promoters have placed a lot of their holding in the company, which could face a margin call or things like that. You don't want very, very fragile businesses or very, very fragile promoter balance sheets.
Okay, fair point. I mean, that was a very basic. I wanted to understand in terms of ROCE, in terms of market share and so on? I mean, basic those parameters, if you could just elaborate for our viewers.
Sure. So anything that you would look at while buying an entire business or entire company would come into analyzing a minority stake in the company. So if it's a very, very competitive environment, obviously the return ratios are very, very poor. Today, any individual can walk up to a bank branch and open a bank FD at 7.5%, the prevailing interest rates for maybe a 1-year bank FD. Now, you don't want to invest in a business where the company is earning return on shareholders' funds or return on net worth, which is single digit. When you are investing in equity and taking business risk, you definitely want a high return on net worth, minimum of 12%, ideally above 15%. You want the business either to pay you back your money, whatever profits they earn, they should pay out either as dividend, or even better, they should be able to reinvest that money on your behalf into high return on capital businesses. So these are some of the basic things that we look for in a business.
Thank you, Mr. Thakkar. This has been a masterclass for investing and how to look forward into equity markets. It's such a pleasure. On behalf of everybody who's watching, I'm thanking you, and we hope to meet in person. Have a nice evening and a fabulous decade ahead, multiple decades ahead as far as creating value is concerned. Thank you.
Thank you for the opportunity. Happy being.
This, ladies and gentlemen, was Mr. Rajeev Thakkar, Chief Investment Officer and Director at Parag Parikh Financial Advisory Services, AMC. He runs India's most popular scheme, Parag Parikh Flexi Cap Fund, which has compounded at 18.8% over the last 11 years. Please listen to this interview again. I will do so as well, and it has immense wealth of knowledge, and it has lots of guideposts that may help you navigate these markets better. Thank you for watching. Have a nice day.
If you don't make your product in America, however, under the Trump administration, you will pay a tariff, and in some cases, a rather large one.